Welcome to the SageWorks series of webinars. This session is on tax return analysis, when the numbers say no, but good judgment says yes. I'm Tim McPeak with SageWorks Inc. in beautiful Raleigh, North Carolina. We work with both the CPA and accounting providers as well as the banking market around the United States. We provide for banks a series of credit and portfolio management products. Let me go ahead and introduce our presenter today. We are very excited to have Linda Keith. Linda is a CPA with a niche practice helping lenders say yes to good loans. Since the 1990s, she's worked with banks and their lenders, underwriters, analysts, and relationship managers to pull qualifying income, spot red flags, understand the business, make a good loan decision, and document it to pass muster with loan committee and the regulators. As important, she has borrowed a lot of money as the CFO of a construction company and as a real estate investor, so she brings that perspective to the training she provides the lenders as well. Today, she will share her insights and the opinions of senior bank and lending management, the regulators, and the lenders on the front line on what is working when the numbers seem to say no, but good judgment seems to say yes. So without further ado, welcome Linda. Thank you very much for being here.
Thank you, Tim. I am excited to be here and be partnering with SageWorks to bring you this very current information on what to do when it seems to be a good loan, but the recent numbers, as evidenced by the tax returns, just don't seem to support that decision. So first, let me just say that this month I've worked in 3 different states, presenting 4 two-day trainings on tax return analysis, helping lenders from 8 different financial institutions. And they represented the type of lending you see on the screen, from small business lenders in a community bank to SBA lenders from a financial institution that has a footprint around the country, a large bank focused on lending and other banking services to the wealthy on both coasts, and ag lenders from 4 states in the Midwest. And in addition to time spent with the lenders, I have had conversations with senior lending management, and I touch base with regulators from time to time as well. So I'm actually reporting to you from the very front lines on what is working and what is challenging as a business seems to turn the corner from a downturn. The loan seems to look good, but recent numbers include some challenging years. Now, the ideas I'll share today apply to pulling out of a recession, but also anytime a business is in turnaround mode. And those same ideas apply to upgrading a loan that was downgraded as substandard as this business starts turning the corner, just as they do to making a new loan decision. Now, when I say lenders today on this webinar, I'm talking about everyone in the chain of events from spotting a loan prospect to taking it to loan committee. In your financial institution, that might be relationship managers, it might be business development officers, loan or credit officers, processors, underwriters, analysts, the whole crew that gets us from spotting the loan to getting to loan committee. So let's look at this title again. When the numbers say no, but good judgment says yes. How do we make the loan? Well, first, do the numbers really say no? I'm going to encourage you to take this 45 minutes or so that we will spend together and ask yourself that question. Are we really getting the numbers right? Now, I know that some of you on the webinar are senior lending management and some may be lenders or others, so modify this question for your role. Are we getting the numbers right? Imagine if you're missing some steps that, if done right, would lead you directly to yes. Wouldn't it be easier to make the loan if your worksheet or your software actually came up with an answer that supported the loan decision? So I will spend a little bit of our time with this part of the puzzle. And before you hastily jump to the conclusion that your process works and that your guidelines are typical of your peer institutions, let me tell you about what happened just this month. I did the same presentation for the same bank, but 2 different teams, 1 week apart. We used a completely customized case study that came from one of their clients' actual tax returns. So I created a class case study by changing all the identifying information, including names and locations, and then modifying the numbers slightly. Now, the result was the same type of return they need to work with week in and week out. The last part of the class, we broke into teams and had a competition. There were 6 or 7 teams. Each team had 25 minutes to review 3 returns in a global analysis and come up with a number for cash flow available to service global debt. They all turned in their answer to me. I took the median, and whoever got in the middle got the prize. Now, in each of these two teams, their answers were tightly grouped around a particular answer, which was very gratifying after 2 days of training. But here's the kicker. The first week, the answers grouped around 1.3 million annual cash flow available to service global debt, which included the business and the personal debt. The second week, the answers grouped around about 800,000. Same tax returns, same bank, different teams, different type of lending, different guidelines. And I'm not suggesting that either team was wrong. The guidelines were just that different. I am suggesting that guidelines do vary, and it's a good time to take a good look at your guidelines if you are in lending management. I'm going to tell you later in a webinar, I'm going to have a resource for you at the end that will provide you with some help on this step. Now, the second assumption is that good judgment says yes. Your question might be, but what is that judgment based on? And today I'll share just a few of the factors that, when misunderstood, can lead a lender to poor judgment as to whether this company is doing well. What we're focused on today, I think, is that situation where it appears the company is turning the corner. But this judgment is based on the most recent tax return and maybe a company-prepared financial statement for year-to-date. We'll consider what the judgment should be based on. Now, assuming that the two premises are true, some of the numbers say no, but good judgment says yes. Then we have questions. What should the write-up include? What should the loan committee consider? What will regulators buy off on? And I'm hoping the answer to those three will be somewhere close to the same answer. So let's start with whether the numbers really say no. Are we getting those numbers right? I'm going to ask you to ask yourself the same question I ask attendees in my live training on tax return analysis before I start with them. So if you're a lender, answer this question for yourself. If you're in senior management, ask and answer the question about your entire team. So I'm going to launch a poll. And if you're viewing the recording, don't worry, you won't see the poll directly, but I promise to tell you the answers we got with those who were attending the webinar. So here's your question. Rate yourself, if you are a lender, or your team, if you're in senior management, on competence, confidence, and consistency in analyzing tax returns to pull qualifying income and make a good loan decision. 1 to 5, 1 would be low, 5 would be high. I'll give you a few more seconds to jump in here. And by the way, it's going to help me because I will get this presentation pitched about right if I know where you feel you and your lenders are. As soon as we get to 80%, I'll show the poll real close. And there's your answer. And for those on the recording, about 41% are a 3 and about 44% are a 4. Some are 1s and 2s, a few are 5s. So that's actually not too bad at all. I would ask you to ask yourself, though, if you selected 3, is that good enough in this environment? Is it good enough whenever you're trying to assess whether improvement in a borrower's business performance is a fluke or a trend? Now, after the webinar, I want you to answer this question again, but this time, rate you or your team in each of the 3 areas. 1 to 5 on competence, 1 to 5 on confidence, 1 to 5 on consistency. And let me tell you why. In the session I did last week in Denver, I met one of the attendees before the class. Now, she was switching from education to banking, and she was pretty new in banking. She did know to add back depreciation. She knew where to put interest expense and where to put the debt on her debt list. But that was about it. And I was delighted to have her in class so early in her career to get her off to a good start. I regularly have people in startup mode all the way through people who rate themselves a 7 on a 1 to 10 scale. Now in class we did a 1 to 10 rating, and she gave herself a 3, which was a real surprise to me. I was expecting a 1 at best. At the break, she explained. She said, "Linda, the few things I do know, I do the same way every single time. So I gave myself a 10 for consistency, and that brought my average up to 3. So yeah, we want to be careful what we are consistent in doing. So consider each of the three factors independently, and that will help you decide what you or your team needs to focus on. For example, if you're bringing on experienced lenders, they may not know your guidelines or your bank's take on what to look for and how to use it. They may not know what's an acceptable compensating factor at your bank, or whether guidelines are guides or hard and fast rules. And you can lose consistency across the team even though the competence is high. So next I'll touch on 4 of the specific areas in which lenders might be getting the numbers wrong. But first, let's do one more poll to be sure I know who is on the call. And again, for the recording, I'll give you the results. So poll question number 2, what is your role in the financial institution? Is senior management like the CEO, chief lending officer, chief financial officer, etc. Choice 2, lending management other. Choice 3, front lines, the lenders, underwriters, analysts, relationship managers, business development officers, and the processors, etc. 4, regulator, and 5, other. And if you choose 5, go ahead and use the chat to tell me what is your role. So again, I'll give you a moment. Okay, let's show the poll results. 74% of you are in the front lines, and about 20% are in senior management. Well, this is great. I'm going to share information that will help you all. And I promise at the end of the webinar, in addition to the guidelines questionnaire, I will be providing some other resources that will be really helpful for frontline teams as well, to help you get the numbers right and get the judgment right. So first, inconsistency. I already hit on this a bit. This can be inconsistency across the team or one lender who is inconsistent from one loan to the next. You know, it's interesting to ask when I do in-house training. I ask a guideline question and I watch their faces. Sometimes there's blank looks. Sometimes they're sort of glancing at each other to see who's going to answer. And sometimes they're absolutely confident and I get different answers from all over the room. And this is particularly true anytime you're hiring folks in from other financial institutions. Now you can imagine being a junior lender at that bank or someone new to that bank trying to follow along with what has been done before in the file and discovering that everyone seems to be doing it differently. I might add, this is a huge red flag for regulators. As soon as they see that whatever system is in place is not consistently followed, and there's no indication in the file as to why this time it's different, you might as well put a kick me sign on your backside. The regulators eventually will have to decide that your financial institution doesn't have a system that is consistently followed to result in good loan decisions. And I can't blame them. Can you? Another is this, and certainly the person I told you about was in this stage, the inability to get beyond the formula. Your lenders may be very consistent at coming up with an answer, but they may be stuck at that formula level. They know what number to put where on your worksheets or software, but in a turnaround environment, they need to be able to apply judgment, get beyond the formula. Another is missing AddBacks. And again, if you are still pretty formulaic, you may be missing some big ones. For example, the customized case study that I used for that private banking group was the owner of several insurance agencies. And these insurance agencies had been buying customer lists, which are amortized, not depreciated. This borrower had over $100,000 amortization in each year, which is a totally non-cash item. Now, almost every team, every lender does learn to add back depreciation early on, and there's a place on the worksheet to do just that. But do they know to add back amortization? Do they know where to find it? So this is just one example, and there are many adjustments needed to get from taxable income to qualifying income available to pay business debt, pay the owners, and cover global debt. Many of them are AddBacks. Are your lenders finding them all? Because if lenders are missing AddBacks, they are missing qualifying income in their analysis. And then there's this one, confusion on pass-throughs. On the 1040 Schedule E, page 2, we see the list, LLCs, partnerships, S-Corps, and the confusion begins. Do I use a K1? Do I have to get the entire tax return? If I use the K-1, what numbers do I use and what can I safely ignore? Why can't I find what I'm looking for on this K-1? Why can't I just use the numbers on Schedule E, especially if they're income and I don't need that income to qualify anyway? This is such an area of confusion that in the 2-day training on tax return analysis that I do, half of the second day is on this. And in the lender's online training, there's 30 modules, 10 on financial statement analysis, 20 on tax return analysis, and of those 20, 6 modules are just on these pass-throughs and K1s, company cash flow, individual cash flow, and global. I rarely say always, but I will say it here. The figures on the back of Schedule E, they are always useless. Useless. They are not cash flow. They're not what they could pay themselves. They're not what they did pay themselves. In fact, underwriters regularly tell me that the lenders are telling them, just use those numbers. They work. No, they don't. And yet the underwriters are having to really push back against relationship managers and lenders who want to use those numbers and think they should be able to. Then there is, of course, actual cash flow from the K-1s versus cash flow available from the entity. Which do you use? Where do you find those numbers? Now, most banks and credit unions base that choice on percentage ownership, but when should the lender come off the guidelines and use the other choice? Or compare them, and if they're hugely different, explain why they are so different. Now, by the way, I haven't had time to go back and really figure out the difference between the 1.3 million with one team and the 800,000 on the other because I've been on the road, but I will tell you, I'm pretty sure this is where it is, what they're using for the pass-throughs. Another way we'll get the numbers wrong is if we just don't treat this consistently. So these are just 3 of the ways you or your team might be getting the numbers wrong. Use your self-evaluation on just these 4 to decide if you need more training on how to derive qualifying income from tax return. What senior lending management should be asking and what regulators should be considering is this. Would your guidelines work if everyone followed them? If they were clearly communicated, consistently applied, and when appropriate judgment was applied to that? Let me tell you what's really happening with lenders. When people attend my training, it's really common for somebody to come up at the break or lunch and say, you know what? I think I've been turning down good loans. They almost never come up and say, boy, have I been making some doozies. Maybe they wouldn't tell me. But my guess is we're passing on more good loans than making bad loans. And one of the things I'll make available at the end, no charge at all, is that tax return analysis guideline checklist. I felt like this was like getting stuff for my kids' Christmas stocking stuffers. They're excited about as much as the bigger gifts. So the guidelines checklist, it is Excel based. It is completely customizable for your own guidelines. And it will help you be sure that everybody is on the same track. So that helps you with assumption number 1. Do the numbers really say no? Now for the second assumption, what is the judgment based on? How might the lenders be getting the judgment wrong that the business has turned a corner when there's really not enough evidence to support it? Well, the first is how important it is to suspend judgment. You know, the first thing we often look at with these tax returns is either the bottom line or even the top line, revenue. Boy, revenue's up, great. Or wow, look, taxable income is up. They may be thinking that taxable income is net profit, which is not true, but neither of those are cash flow. So I encourage lenders to hold off on forming a judgment and wait until they get enough done to have a better understanding. Lending has a subjective element. The moment that a frontline person thinks business is up, it'll cloud the rest of their analysis. And of course, the reverse is true too. If they form a judgment that the company's still struggling too early in the process, they're likely to ultimately turn down a loan maybe they could have made. the impact of cash basis tax returns. Now, I only have time for 4 of these, but I am picking the ones that I think are the big ones, and this one surely is. So let me give you an example. Maybe a business borrower was doing well, but their customers were struggling. So they did the same amount of work as always that year, but in their judgment, their customers were good for the bill. So even though their customers were falling behind on the payments, they did the work and they let the accounts receivable sort of bloat. Well, on a cash basis tax return, question, what will happen to the revenue? It's going to be lower because they haven't received the money. The lender can't tell if they did the same amount or even more work, but have not collected all of it. Or if, on the other hand, the activity level is actually down. So if you're just looking at the tax returns, but you have not even noticed if it's cash basis or accrual basis, you can assume business is down when it is not. Now, eventually, if you're looking for it, you'll notice the cash basis indication, but by then your impression is already formed. Now, some of you on the webinar may do commercial lending to bigger companies that provide CPA reviewed or CPA audited accrual basis statements, and you may be using that instead of tax returns. But given the title of the webinar, I'm assuming most of you are using the tax returns, cash basis and all. Now, just to be clear, cash basis tax returns can give us the wrong impression in either direction. We'll use my company as an example. So when I schedule an in-house training, I get a 50% deposit when the program's booked. And for the open enrollment series, where a financial institution can send a single participant, registration and payments made in advance. So I have the money before I've actually earned it. If I've booked more business than usual by year end and received deposits on that business but haven't done it yet, the current year revenue is inflated, the tax return cash basis, and the following year, unless I do the same thing, the end of that year, tax return, cash basis, revenue is actually down. So compare the years and you'll think my business is suffering, even if I actually did more work the second year than the first. So what I encourage you to do, and what I train the lenders in the tax return analysis class, is to do a snapshot of the business first, and it covers about 10 items. Just gives them a sense of this business, the size, the scope. It helps them to spot red flags, anomalies, things that should be questions. And one of those snapshot items is whether the return is on the cash basis or the accrual basis. And I want them to notice that before they start comparing years and drawing conclusions. Well, that leads us to the next one. Combination of tax returns and interim financial statements. Tax returns and financial statements, even for the same period, can vary for legitimate reasons. So it could be depreciation methods, inventory, accounting basis, just to name a few. But if the difference is cash versus accrual basis, we actually can lose a chunk of income or double count it. They may be reporting revenue in 2 different years, the same revenue in 2 different years, or not at all, and it's done completely correctly, totally legitimate. And what's worse, they may not realize how you plan to use the combination of prior year tax returns and current financial statements, so they won't even bring it to your attention. So go back to my earlier example, but have the deposits received for those trainings in the tax return year, and then the revenue earned in the financial statement year. So I will correctly report it in both places because I received the cash in the earlier year, so cash basis tax returns, it's revenue. I earned the revenue in the second year, financial statement, accrual basis, it's revenue. It's actually in both. So if you don't spot this, your impression of the business will be way off. Experienced commercial lenders with accrual basis information for the years in question, they do know how to look at those balance sheets and compare beginning to ending receivables, beginning to ending payables to decide if the cash basis and accrual basis probably are fairly close to the same number. But many small business bankers and consumer bankers, they just don't. So one of your goodie bag items at the end of this webinar will be a 30-day trial of my lender's online training. And one of those modules is on cash basis versus accrual basis. So that would be a good one for you to review if you have any questions on why this can throw both the numbers and the judgment off. Gee, business is better for local developers, so I expect this business is up too. Maybe not. So local and general trends, they are important, but we can't exactly extrapolate them just to our borrower. In fact, one judgment mistake is that all businesses had a tough time during the economic setback, and that's not necessarily true. Or that all geographic areas were hit, and that isn't true. So be cautious in relying on local and general trends. You've got to apply that to information actually from the borrower. The impact of seasonality is one that especially unseasoned lenders can miss. Or seasoned lenders, but primarily doing personal and consumer loans and perhaps not with business lending background. So let's say you're looking at a 6-month interim financial statement. Oh, it's so much better than half of last year. But in order to really assess the first 6-month statement, you would have to compare it to a first 6-month statement from prior years to remove seasonality from the equation. And finally, here is one more we have time for in this short session, the borrower story. Over-reliance on the borrower story is the challenge. The borrower story, it's critical. And it's the key to the last part of this webinar, which is how to make the loan. But we can't just rely on the borrower story. For most borrowers, you ask them how's business, the answer is likely to be short and sweet. Applying good judgment to the numbers and the borrower story is essential to the final step, how to make the loan. No software, no worksheet, including mine, including SageWorks Analyst, both of which I think are great systems. None of them can give us the information we need for our own decision making to sell the loan-to-loan committee to get it past the regulators unless we apply judgment to the numbers that we use. Whether how to use the cash flow from capital gains, how to understand and adjust for a down year, whether to be concerned that the owner guarantor took more out of the company 2 years in a row than you think the company can sustain going forward. Those are judgment calls. The successful lender and the successful bank will learn to get the numbers right and the judgment right in making the loan decisions. Well, hopefully between the few things I could share in this short time on those two assumptions and the resources I'll provide you at the end, you can assess how you are doing at getting the numbers and your judgment right. So, how do we make the loan? I had a conversation just yesterday with the senior banking regulator in the state of Washington, Richard Riccobono. I told Rick I need your latest thinking. What would you say to the lenders if you were on this call? Now, the good news is that he and I are in agreement, but he emphasized a few things that I'd like to share with you. We need to ask the borrower, the business owner, or management some questions. For example, I see that things seem to be going well. To what do you attribute the turnaround? You know they have a story. Let them talk. Ask them what changes have you implemented in the last few years? Have they just waited it out, or have they been proactive in responding to changing circumstances? What worked? And as importantly, what did not work? Let me share an example from my own company. Like community banks with a great niche in commercial real estate that turned into a concentration risk when the downturn happened, well, my niche was in community and regional banks and credit unions. As the banking industry took a hit, financial institutions took steps to preserve capital, and rightly so. In the face of dropping revenue, increase in loss provisions, as some of their loans were downgraded, sometimes even as the borrower continued to make all payments as agreed, the banks, credit unions had to look at other costs for the savings, and unfortunately for me, the training budget was an obvious answer. I took a look at my client base to see what opportunities were in fact still hidden in there. Two areas in which I have specialized knowledge are ag lending and the lending side of private banking. Those segments of banking didn't take the pounding that other segments did, and I had clients in each. Now, of course, I could have pursued this strategy any time in the last 10 years to increase my business in those sectors, but frankly, when everything was going well and there was plenty of revenue from all sources, I didn't do so. But now it was worth doing. Now, I've not abandoned my community banks and credit unions. I still offer the open enrollment sessions so they can send their new hires as they come on. I just don't make as much money in those areas as I did and as I will. So I pursued a strategy to increase my ag lending and private banking base, in part by adding customized case studies and materials and going after more of those kinds of clients. It took several years to do it, but if I hadn't started, I wouldn't be enjoying what is now the best year in my 30 years of business this very year. When I started on this path, I had one yearly ag lending client. Now I have 7. If you were my lender and you asked, that's the story I would tell you to support your judgment that this year is part of a trend, not a fluke. So what to listen for? Listen for strategy decisions. What did they do differently? Consider my story. It started with revisiting my strategy, then adjusting that strategy, implementing, revisiting, adjusting, implementing, and the cycle continues. Listen for action. What have they done? What are they doing? Are they in forward motion, or do they just pull their head in like a turtle and sort of hope that things would get better? Because the companies that did that in many cases aren't doing as well now as the ones who got proactive, got strategic, and watched what was happening carefully. Course corrections. That's why I like to ask the question, what didn't work? I want to see what they're doing to pay attention to what works and then change it if it's not working. So here's an analogy for you. I'm a sea kayaker in some of the coldest summertime waters in the entire United States, Puget Sound. One day, a group of us were gathered at the tip of Squaxin Island, ready to cross to this marina. Now, that's 2 nautical miles, normally would take about 1 hour. But while we were out, the weather had changed and the winds had come up earlier than planned. There are 1-foot waves out there, which may not seem high unless you're in a kayak pretty much at water level. It happens that the way a paddler gets to shore in rough waters is very similar and provides some lessons for businesses that are trying to make it through turbulence in their industry or in our economy. You can hear the similarities in their story to my story of getting to the marina. So first, the game changes. No longer are you trying to perfect your forward stroke or look good in the water. Now, frankly, the big objective is stay in the boat. And frankly, if you stay in the boat and make it to the marina for that particular next 2 hours or hour of 2 nautical miles, that is the victory. So your question, what has this business done or done differently during this turbulence to stay in their boat? Next, maintain forward momentum. You're much more stable in a kayak when moving forward. And frankly, if you don't move, you are not going to get to the marina. Then third is to be ready for course corrections. Turns out your boat just does not respond in rough water the way it does in calm seas. So by the time I was in the worst of it, every single paddle stroke had to be a correcting stroke. It was critical to keep my eye on the goal, the marina, and keep adjusting to get there. And then fourth, I had to narrow the focus onto shorter term objectives. I kept my eye on the marina, and that's where I was headed. And many business borrowers, they went from yearly budgets, then they were doing quarterly budgets, then they got down to monthly. In my case, in my company, there was a point at which we were doing a 13-week cash flow, and we updated it every other week because I needed to have good information more frequently. So when you ask for the borrower's story and sit back and listen for strategy, action, frequent monitoring of their situation, and the course corrections along the way. And the good news is many of the changes made in the downturn will actually have continuing positive results. So notice that when you're listening to their story and include your observations on the positive and continuing changes they've implemented in your write-up. Listen for documentable results. So think back to my story. I said I had one ag lending client before the recession, and now I have 7 yearly clients in this area. Well, could you ask for the list? One year, the commercial lender for the construction company that I worked for as CFO asked for the updated information to renew our operating line of credit. Now, because of a cash basis versus accrual basis distortion, that most recent year looked like a downturn, but it wasn't. The good news is we had a long-term borrowing relationship. So when I said to Kathy, here's the tax returns, but it's not really reflecting what happened last year, she wasn't overly suspicious. She did listen to the explanation, and it did make sense to her. It made a difference in her loan recommendation. So here's what she did. She said, Linda, I want to advocate for this loan, and what you just told me is very helpful. So would you put that in the letter requesting the renewal of your operating line so I make sure I get it right? Brilliant. She now had it in writing from me. It was signed by me. And she didn't have to worry if she was repeating it accurately or getting all the facts. And I was happy to do it because she needed to advocate for me. Wonderful choice of words and a great technique if what you're hearing from your borrower is making a difference in your loan recommendation or your decision. Now, how to document it for the loan committee and for the regulators. This is the real emphasis of Mr. Riccobono, the Division of Banks Director. He said, make sure you address the concern. Because if you're hoping no one will notice, that's a bad idea. Come right out, state the concern, and then explain why you think it's covered. Now, how can senior lending management make sure this happens? Well, you could take some of the questions we just covered. Here's what we want you asking and listening for when it seems like the business has turned the corner, and you could push that out to your lenders. And then when they come to loan committee to present, you could ask those questions. And then finally, you could look to the files to be sure that that kind of observation and those judgments have been documented. We also need to document the borrower discussion. For some lenders, this requires an improvement in the way they write the questions and answers in the file. Some are way too cryptic. In fact, I've been the borrower on the other side of the table, and I could tell by the way they were jotting down my answers to questions that unless they could use that information, in the next hour or so, they weren't capturing the essence of what I was saying that would be important for them to remember much later or reiterate to loan committee or be able to ask better questions the following year because they remembered what I'd said that year. And some experienced lenders think that the information's obvious, so they don't write it down. But the regulators can't tell what the lender is thinking if they can't read it. From the borrower discussion, be thinking about what could be added to the file to document the judgment that the company trend will stabilize and continue. Maybe it is association publications. Maybe it's something from your local economic development council. But what is documentable that you could get evidence not only from the borrower, but maybe from some other sources? Now, this is a screenshot from SageWorks. I think this is their CPA product. Notice the stars to highlight what is doing well. And then they are really good at putting into narrative and putting into words what the changes in the numbers mean. So as an example, if revenue is up and profits are down, what happened? It could be that because revenue is up, the company is now spending some of that excess revenue in expense areas that they had sort of stopped during the recession. Maybe they're buying equipment. Maybe they are hiring back employees in anticipation of delivering on some of these new contracts that they've recently signed. So, good write-up helps the lender remember why the judgment was made and ask good follow-up questions the next time they're interacting with this borrower on the next loan request. It also helps loan committee understand and assess the lender's thinking, and then it helps the regulators understand the reason for the loan decision. Before we open it up to questions, let me share some of the things I put in your goodie bag. First, the link at the top, www.lindakeithcpa.com/SageWorksWebinar.htm. Now, this link is not accessible from the general site-wide navigation, so you do need to type it in, and you do need to put .htm at the end. The first gift in the goodie bag is for senior management. You can see what I have for guidelines and then modify it for your own guidelines. And whether you use this resource or not, I strongly encourage you to take a critical look at your guidelines right now and see if they are up to snuff. I was an examiner for the Washington State Auditor's Office, auditing federal contracts. I know how examiners think. And as an examiner, I want to know there's a system in place that would work. SageWorks Analyst is one of those systems. I want to know that the lenders and others in the chain of events have the training to use it. I want to know that these guidelines are clearly communicated and consistently applied. And I want to know that appropriate judgment was brought to the loan decision and I can tell what that was. And I want to know that the process is adequately documented. It all starts with adequate guidelines, clearly communicated, and this tool will help you. And if you're on the front lines, download this tool and see if you can adjust it to your financial institution's guidelines. If you discover some guidelines you're just not sure on, then great questions for a senior lender. I just did a 20 video series on pass-throughs and K1s, and this is a great resource for the lending team. Now, it's not even out yet as I do this live session for SageWorks. So when you get to this URL, sageworkswebinar.htm, you can ask for information on this. And as soon as it is out, I'll get you the information on how to get your access to it. Now, what I did on this area of pass-throughs and K1s, which I find is one of the biggest sources of confusion, is first I asked and answered the 10 frequently asked questions. And then I asked and answered the 10 questions that lenders should be asking. Our 21-page tax return analysis quick reference guide is my Excel-based cash flow worksheet, but in PDF form, with all of those help boxes opened up. And it's much shorter than the full-blown self-study and reference manuals, which are over 400 pages in 2 manuals to cover all those tax returns. And you can sign up for our AskLinda email. Monthly, just came out yesterday. Yesterday's topic was the K1s, and specifically the difference between items listed in the passive section of the Schedule E versus the non-passive section. I sort of call this monthly email the drip method of learning tax return analysis, a little bit at a time. And those questions always come directly from lenders every month. Here's another free resource for you. At the top of my site, www.lindakeithcpa.com, there's a magnifying glass, and when you click on it, a site-wide search box opens up. So you could put in K1, or negative 263A costs, or AddBack LIFO reserve, or guaranteed payments, whatever you need to know. And if I have ever answered a question on it or written about it in my blog for the last 4 years, you'll get the list of those posts. Here are some samples of the questions archived at the site. Now, this would be bragging if it were not true, but my clients tell me that this is the most comprehensive site on the World Wide Web for lender answers to tax return analysis questions, and I'm happy to share that resource with you. So, let's open it up to questions, or you can make comments or offer an observation as to what you are seeing. Tim, do we have any questions?
Linda, we do, and just so the audience knows, we can continue to take more during this time, but you mentioned K1s, and we do have a K1 related question. The question was asking, can you outline some differences between the K1 data and what they'll see on E Part 2 of the tax return? And also, how does that affect cash flow?
Sure, Tim. So Schedule E lists this individual owner's share of the taxable income from the source return. So let's say the source return is a 1065 filed by a partnership or LLC, or an 1120-S filed by an S corporation. Now, if the S corporation shows $100,000 of taxable income, and I'm a 50% owner, half of that, $50,000, will be reported on my 1040 Schedule E, page 2. But that is a taxable income number. If we could use the number on the back of the Schedule E, taxable income, we could just use AGI and save a lot of time. So I don't use the numbers on the back of Schedule E, page 2 in your 1040. Now the K1s will give us information on the cash flow actually paid out to the owner. The 1065 K1 and the 1120S K1 are not quite the same, so I can't give you the formula here, but it is on one of the online training courses on the subject, and you have that opportunity to sign up for the 30-day trial and can take the modules for both returns if you want to do that in that 30 days when you get to that URL. Now, I don't want to stop there, though, because there is another number in play. So, for example, I'm 100% owner of my S corporation. It would not be wise to use my K1 distribution. I pay myself whatever I want. What the company can afford is a much better guess as to what I'll be able to pay myself in the next few years. And this comes from the fact that there's actually 5 sources of cash flow to pay debt or to pay an owner. And we as lenders only want to use typically one of those, cash flow from operations, for recurring cash flow. Tim, any other questions?
We do have another one, Linda. The question is asking, if the bank has approved a loan and the company has had a rough year, are there any potential red flags that may be picked up by a regulator when they are reviewing that loan?
Well, the red flag is the declining situation of the borrower. Be sure, though, that you have the numbers right and the judgment right. Now, regulators are looking at the trends. And do you understand what has gone wrong? Once you understand that, can you describe what the borrower, the business borrower, is doing to turn it around? The same questions apply, and we are listening again for strategy, action, course correction, and documentary evidence. What else, Tim?
Anne asks if you can review your previous example of cash basis versus accrual basis income that drops off or is double counted.
I'd be happy to. Now, I gave you the example of double counting, but let me hit it again, and then I'll give you an example of lost revenue. So here's the example of double counted revenue. I charge my clients 50% of the training fee as a deposit when they book the date. Now let's assume the date is booked the end of 2010, and I present the training and earn that revenue early in 2011. 2010 cash basis return, I received the deposit, and I correctly included that revenue in the cash basis income. 2011 accrual basis financial statement, I earned the fee by presenting the training and correctly include that revenue in accrual basis income. So the revenue received in 2010 for work done in 2011 will show up in both the 2010 cash basis tax return and the 2011 accrual basis financial statement. And they both are done correctly. So here's an example of lost revenue. 2010 cash basis return. I did some work at the end of the year and I billed it out. Now, since my tax return is on the cash basis, I didn't enter it as revenue. I'll enter it in the 2011 tax return when I actually get the payment. 2011 accrual basis financial statements. I get the money I earned at the end of last year, but since I didn't earn it in 2011, I will not show it as revenue. Instead, it will just decrease my accrual basis balance sheet asset accounts receivable. So the revenue received in early 2011 for work done the end of 2010, it just won't show up either on the 2010 cash basis tax return or the 2011 accrual basis financial statement. And once again, they both are done correctly.
Linda, we have a couple of other fairly specific scenario questions which may make more sense for you to address directly after the session. So those of you who submitted them, we'll get them to Linda and she will respond directly to you. Just to wrap it up from the SageWorks side, we want to thank everyone for attending today. We've had some questions regarding access to the slides and the recording. We are going to make them available on the SageWorks website. Otherwise, we just want to thank Linda again for her time and expertise. And Linda, why don't we turn it back to you to wrap things up?
Well, when we sign off, go get your goodies at www.lindakeithcpa.com/SageWorksWebinar.htm. And remember the site-wide search function, and you can contact me directly at my email address, linda@lindakeithcpa.com. It has been truly a pleasure to work with SageWorks to bring you this information. I believe businesses are the engine of our economy, and it's the lenders who provide the gas. It is my pleasure to serve you.
Thanks again, Linda. Thank you, everyone, for attending. Have a great afternoon.